There are a few things in your house that are more worth your time in learning how to read and understand than your annual tax return, known as a 1040. Understanding what's on there, why it's on there, and how to possibly reposition some of that income for the future can be the difference between a successful retirement and an unhappy one. Join us on Consider This Program today. We're going to teach you how to read your tax return. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Jamie Burton.
Happy to have you along. Hey, you know, there are a few good books in your house that you probably need to read. One of them comes out some Sundays. You ought to spend some time with it. Some good stuff in there, as I tell my kids. But the other one is one that is just ignored. And I'll tell you, I think I know why. But it's your annual tax return. It's your 1040. And what happens is the year is over, right? You get all of your stuff together in March, get it to your CPA or whoever does your taxes, including yourself, right? You do the return one time a year. You probably get frustrated over what it says. You throw it in a drawer and you repeat and do the same thing year after year. We do not have meetings with people where we don't have a tax return. And I've had people for years say, Joe, I've never had another advisor ask me for a tax return. Ladies and gentlemen, I don't care if it's you who are serving as your own fiduciary or if you're working with somebody else. If they don't know how to read your return and they're not helping you walk through it to put you in a better situation, I would strongly encourage you to go to yourlifeafterwork.com and get signed up for a Next Steps meeting because you're missing out. There are 4 areas. We call them the fiduciary focus. Remember, our job, our fiduciaries, is to treat your money as if it were our money and we were in the same situation. And every day of our lives, we're looking at risk and volatility, right? Those are 2 separate things, but that's one category. That's how the investments are working. 2 are fees and expenses. What are you paying and who are you paying it to and why are you paying it? 3, taxes, but it's both today and tomorrow. What's that financial journey for you and the IRS going to look like as you meander through the rest of your life? And then 4th is the real return. That's dealing with inflation, the purchasing power. And just to give you an idea, one of my dear friends is retiring. The monthly income is going to be about $6,400. I took out and went over their life expectancy and let them know that if we die on time, which at our age, at 54, is about 84 and a half, right? When we look at that, at 3% inflation, she's going to need over $14,000 a month to maintain the same standard of living. Folks, you got to get this part right. And one of the biggest things you can do is to learn to read that tax return. So, Jamie, you're up.
Yeah, so like Joe said, a lot of times when families come in and they bring this tax return and he said, yeah, I saw that in the email that you had requested to see my tax return. I don't know that I've ever even looked at my tax return. I take my stuff to the CPA. I let him file my return. I cringe when I have to write the check to the IRS, and then I file it away in a drawer. I've never even considered looking at that tax return to figure out what is actually shown, what's listed on this tax return. So something really important that we do in our meetings with our families is to review that tax return and explain what that tax return is telling us year after year. Because we know that if you wait until March of that year to file your return, you've already missed all of your tax planning opportunities that typically need to be done by December 31st of that year. So when people come in with their tax return, we sit down and we go through line by line of what this tax return means. So we have what are called above the line costs. So you have your W-2 income that's listed there. You have any interest or dividends from investments that you have. You have listed there if you've taken out any distributions from an IRA or if you have pension income. And all of that is totaled up to what is called your adjusted gross income. A lot of people think that adjusted gross income amount is the amount that they are paying taxes on. That's not the case. After you have that adjusted gross income, that is when you determine if you are going to be taking the standard deduction, which is the deduction that the IRS says that you can take without having to list off the deduction specifically, or you have what is called an itemized deduction. So that is what I just said, the items where you have your state and local taxes, you have medical expenses, you have interest, and then you have charitable gifting. So that's where the money comes off of your adjusted gross income. And then you have that last line there called taxable income. And that is the income where it determines what tax bracket you're in and how much taxes that you are paying.
Very well done. I like it. So the best way to think about our tax system, I always show people before I go to the return, is a series of stair steps, and you've got those things above line, right? So these are real technical, above line and below line, right? But that's really where you have to start. And whether it's Brett Spangler that's in here with us, or Ben Smith, or Link Perkins, or one of the other CPAs we work with, Mike Layer, Michelle Skeen, regardless of who they are, those are the terms we talk, and those are the ones you really have to know. And so, some tax returns are, more than 100 pages long. If you've got a bunch of stuff, farm ground rentals, things like that are out there, and some are, 4 or 5 pages long. These don't have to be real complex, but, Jamie, you're right. I can't tell you the number of times when somebody showed up with their tax return and the envelope has not been opened, right? I mean, it's still sealed. And, I go, okay, we really, really need to work on this and try to get out there. But so talk to me on, we've been talking about the 7 things you need to consider before retiring. And you said you were going to go to the above the line and look for IRA distributions or Social Security. What should people be thinking there?
Well, so based on what your income is, and if you have Social Security, we know that up to 85% of your Social Security can be taxable. So we need to look and see what income is being listed on that tax return and what percentage of your Social Security is being taxed, and if there's ways to plan around having that much of your Social Security taxable.
Yeah, what we see a lot, though, is that people will come in and they're thinking about taking Social Security, and they've got $1 million sitting inside of an IRA, right? Without understanding that those required minimum distributions are mailbox checks. They will come in at 72, whether you want them or not, plus all of the growth on your money. And so there's times when it's kind of like, okay, you haven't taken Social Security yet, and you shouldn't, right? Now, here's the one, and this is the one that's my favorite. In Central Indiana, guys, if you've done well, if you've paid off your house and, lived well within your means, it does not take a lot of money to maintain your standard of living. And so I don't know the number of people that I have watched that, because they didn't pay attention to their tax return, created a massive inefficiency. And I'm actually going to see I think next week or the week after. But for the first 6 years, she refused to let me see her tax return. And, so this is early 2000s when I started working with her. And she just refused. And it's kind of like, I finally got her to, all right, show me the bloody return, right? And so we sit down. She was living on $24,000 a year coming from Social Security, with $1.8 million sitting in a 403B account at Purdue University. So in some cases, Jamie's going to work with you about not putting extra income above the line. In this case, she had about $15,000 to $20,000 a year that she could have been taking out of that 403B every year and paid almost nothing in taxes on it. Her kids are all 6-figure earners, right? It would have been much, much better for her to pay the taxes, even if it were at the 10% bracket. But that's the absolute inefficient use of a tax return. And this is why you've got to know how to read it or work with Jamie. And a lot of people, and this is, I don't mean I want to use all your time, but this is a self-confession that you need to understand. So I will do that in the outro. Do you have any final points you want to make on the reading the return?
Yeah. So when we're going through your return and reading it, one of the things that we focus on is, okay, did you take the standard deduction or did you itemize? If we see that you took a standard deduction, something that we're going to look into is, are you charitably inclined? Have you been gifting and you just aren't gifting an amount that's above that standard deduction, so it no longer makes sense to itemize? But what if you are charitably inclined, you have those state and local taxes and some mortgage interest? Does it make sense to if you add those together for 2 years in a row, does that go above the standard deduction limit? If so, then we would look into what we call double stacking. So that's when we do 2 years of charitable gifting, 2 years of paying your state and local taxes, 2 years of paying off your interest. And then in that year, it makes sense to do the itemized deductions. Then the year following that, you don't do any of the gifting or paying the interest or the state and local taxes, and you just go and take the standard deduction. And then you just keep rotating year after year and try and make the most of the itemized deductions and that tax return for that year.
Yeah, the interest one's a little harder to do than the deduction, than the charitable and the other, but it is a well thought out and often implemented strategy at the Financial Enhancement Group. Now, what I commonly hear from people is, Joe, my CPA's doing this, or shouldn't my CPA be doing this? And it's this: your CPA can do it, but their focus is really on tax reporting. I have CPAs that do our corporate returns, CPAs that do my personal returns. They do the tax reporting. We work collaboratively to do the tax planning. I say, here's my thought, here's the idea, here's how we're going to develop it. We work with different families that, where the CPA does the reporting, we do the tax planning, but we collaborate to come up with the best strategy for you. But bottom line is, most places just do not have a year-end process that gets put in gear. Our team is going to mail out what we call our tax package. It goes out the first week in October. It's going to give you 8 to 10 things that you need to think about in terms of what we call income variability. We don't see that many new people toward the end of the year. We spend our time with our families. There's over 1,077 families we take care of at the time of this recording, a little over $650 million, that we manage. And our focus is making sure that it is tax efficient as possible. If you want us to do that for you, we're happy to sit down and have that conversation, see if it makes sense. We're fiduciaries. It's our job to treat your money as if it were ours and we were in a similar situation. We don't sell products. We sit down and provide that good guidance to the best of our ability, if you will. Go to yourlifeafterwork.com or call 800-928-4001. Get signed up for your Next Steps meeting. Jamie and the team will give you over 90 minutes. We'll give you things to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and they'll put it in writing. Again, that's 800-928-4001 at yourlifeafterwork.com.